Hello and welcome to the ASB Investment Podcast, a show that keeps you up to date on the markets and helps you make smart choices with your investments. These are entirely our own views. It's not investment advice, but we know plenty of experts at ASB who will be happy to chat if you need. I'll start today's podcast by saying, wow, we're 3/4 of the way through the year already, and gee, a lot's been happening. As you'll probably be able to tell from the sound, I'm still stuck at home recording this podcast from the comfort of my office. And gee, it's a week into October and we're already really busy. The Reserve Bank of New Zealand's raised the official cash rate. Global investors have had a few things to be jittery about over the last month or so regarding some offshore developments. And we're still in alert level 3 for us in Auckland and some folk in the Waikato as well. On a positive note, having lagged over the first part of the year, the local share markets posted quite encouraging gains over the third quarter, and that's been good news for our investors. So there's plenty to talk about, and joining me from Singapore is BlackRock's Asia Pacific Chief Investment Strategist, Ben Powell. Ben, thanks for calling me today.
It's great to be with you, Chris. I hope you're keeping well and getting through this very strange time. Hopefully we're coming towards the end of it and can get back to something a bit more normal as soon as is practical, possible and safe.
Yeah, that's pretty much the story, isn't it? How's it going up in Singapore? It looks like the latest outbreak up there is tough, and like New Zealand, it's harder to get on top of than last year's waves. Is that the feeling up there?
Kind of. I mean, I suppose the new strategy is not so much to get on top of the outbreak, but to deal with it. So we've gone from kind of highly restrictive measures, and during that time we vaccinated kind of everyone. So I think we're at 80% total vaccination rate. So not everyone, I shouldn't say everyone, but a very high vaccination rate. So with that kind of in the bank, we are now carefully, cautiously kind of going for it and opening up even in the face of, I think, 3,500 cases today. Even with that, the game is now live with it, I suppose, which isn't a great outcome, but seems to be maybe the outcome that is available, and therefore that's what we've got to work with.
Yeah, New Zealand's at that sort of tipping point now. We're not there in terms of the vaccinations. They've picked up a lot over the past couple of months. We're sitting at around 50% fully vaccinated and 80% with one dose. So there's still a bit of work to do, and hence we're still fairly restricted here and working from home, as I mentioned. What about you? Have you been working from home, or do you get into the office? So tell us a bit about your role and how it's working.
Yeah, with pleasure. So I'm the Chief Asia Strategist, and in the olden days I used to travel around, including to New Zealand, of course, to kind of talk about what we as the world's largest asset manager, what we're seeing, what we're thinking, and so forth. And I have to say that seems like a different universe or a different lifetime, because for the last 18 months and more, I've been in my little room here. I guess I get out occasionally, but in terms of a work context, this little room at home has been my base. So we're still at home for the most part. That hopefully, as I say, is going to change in the not too distant future. But for the moment, it's still a virtual life, virtual existence with Zoom and 150 other platforms that we've all got familiar with over the last 18 months. So still at home and still, I'll be honest, I mean, I am struggling would be a bit strong, but I am very much looking forward to getting back to the real. It seems to me the real world is better than the virtual world. So I can't wait for that, but not quite there yet, unfortunately, Chris.
Yeah, that sounds very, very similar, and we've got used to living without things like lock-ins that we used to go to for data releases, being able to go and meet with the Reserve Bank of New Zealand and so forth. And today we did yet another official cash rate meeting where we were just all staring at online and refreshing our screens, waiting for the news to come out, rather than being in the dealing room or in a briefing room. So yeah, it's a bit of a change of scene, but in some ways we're getting there, and it's good that we do more stuff like this podcast, which we can use the technology to make it work. And on that note, did you get a chance to have a quick look at the Reserve Bank announcement today? one of the first banks to hike our official cash rate.
I did. I mean, it's so interesting. RBNZ, something of an outlier, I guess, in terms of hiking. I guess hiking in general is quite unusual globally, but in particular hiking while, restrictions are still there. But I guess that's because they're much more focused on the medium-term outlook. Chris, I'd be so interested. How are you guys seeing it, both today's kind of move and maybe what's going to happen, I guess, specifically with mortgages? I'd be interested because that's, I guess, very important to many people listening here. And, it's a key, maybe the key rate in their life is mortgages. So how did you see it? What do you think is going to happen? And I'd be particularly interested in any comments you might have on mortgages, Chris, if you've got.
Yeah, that's good area, and you're right. Mortgages are where the rubber hits the road, and they just got so low by New Zealand standards over the last year or so, and the Reserve Bank had telegraphed pretty strongly this rate hike. We expected it at their previous meeting, but that was right when the outbreak occurred. And I must say, in the days running up to this meeting, we were still sort of pinching ourselves going, are they really going to hike when we're still grappling with COVID? And today, when we looked at their actual commentary that they put out along with the announcement to lift the cash rate by 0.25%, they're very much focused on the medium-term outlook, where the economy is now starting to run pretty strong and has been generating quite a lot of inflation pressures. So not only have they lifted the rate today, but they've stuck with that message that more increases are coming. And the interesting thing for mortgages is they'd already risen for some of the longer terms at least, well over 1% since the lows of the start of the year. So we haven't seen massive adjustments or any big sort of changes on that front yet, but we were getting down to mortgage rates close to 2%, and now they're all getting up in that 3 to 4% range. So they've risen quite a bit, and we think that this signalling today from the Reserve Bank probably means they've got a bit further to go. But by a historic basis, rates still aren't high at all. If you can still get some mortgage terms for below 3%, which in a New Zealand sense is the last time we saw that was back in the 1960s. So they're still low rates, but definitely on the rise. So that was our take on today.
And what's, if you don't mind a follow up, what's driving that? I mean, so normally there are concerns that very low rates can create asset inflation, I guess, property and so forth. Is that what's on the RBNZ's mind, do you think? Are they nervous that we could see, house price inflation persist, and that can be kind of disharmonious, right? It can create incremental inequality and so on. Is that kind of the RBNZ? Is that their key motivation, do you think, for trying to carefully, I'm sure, but kind of trying to carefully resist that, I suppose? Do you think that's where they're coming from?
Yeah, there's a couple of aspects to that. One, in the New Zealand economy, we get a tremendous wealth effect from house price appreciation in a similar way to the US share market. And so when we see these periods of really strong house price appreciation like we've had over the past 12 months, it often goes hand in hand with broad strength in consumption and in turn inflation pressures. But the Reserve Bank also, from a housing price perspective, has for many years now leaned on their macroprudential tools, so their lending restrictions, and they brought them back into play earlier this year. But I think now the rate increases are part of a concern about just the overall strength that's been spooling up. Largely because of the strength we've seen in the housing market. So, but they really tend to try and keep them separate. But those macroprudential tools, hand in hand with these rate increases and expectations of more, should certainly go a long way to dampening down the pressure we've seen in the housing market. And I think they'd see that as a very, very favourable development. So, yeah, it's a very interesting time, and it'll be interesting to see over the next 3 months, because we're now going into what's really the really busy period for housing markets as we go into spring. But at the same time, a third of the countries are still in quite high lockdown. So it's going to be a very interesting period for mortgages and for potential home buyers over the next few months, that's for sure. So it feels like a long way ahead, though. Like what have we seen? Norway and South Korea as other central banks that have raised rates, but it still feels like a long way ahead of the major central banks in the world. How out of sync do you think we are here raising rates compared to your expectations of other central banks raising rates around the world?
Yeah, Chris, it's pretty unusual. So I think you identify the right spots. I might want to add China it's a different kettle of fish for all sorts of reasons, but China kind of didn't cut rates and stayed astonishingly kind of prudent or even hawkish through the COVID situation, which in China still persists with restrictions. So China's a bit different, but let's stay with developed markets. What's so interesting is, it seems to us at least, that at BlackRock, that the Fed and ECB and other central banks are staying dovish, very dovish. We can talk about tapering and so on shortly, but it seems philosophically these other Western central banks are staying dovish to try to support what the Fed might call diverse and inclusive growth. And basically this, the Chinese phrase I like is social harmony, right? The sense that we're all in it together. We've had a tough year and a half. Let's keep rates low, run the economy a bit hot because that'll be great for the labor market and for people generally, right? So that's kind of where it seems to us, at least, where the Fed is coming from. But in Korea and maybe New Zealand, you guys would know a lot more than I, but it seems there's the same sort of thought, which is we want to have a focus on harmony, and inequality is bad, and therefore raising rates is actually a good idea, because if house prices become unaffordable for the younger generation or for people more generally, then that's not necessarily good for the country either. So it's quite interesting to see, I guess, the RBNZ, Bank of Korea, a couple of others. I think they've kind of got the same initial premise of naturally trying to help their peoples, which is something like obvious, but I guess that's where we're all coming from. But the conclusion they come to from a policy perspective is radically different. And it seems to us that the Fed is really going to stay very, very dovish, even as they taper, which I think is something like a specific response to COVID improving. We can talk more about that. But for us, tightening, meaning interest rate rises in the US, is still a long way away. So I think there is quite a distinction maybe between a relatively small number, low number of central banks, RBNZ will be one of those, versus some of the other big guys, I guess, the Fed perhaps chief amongst them.
Yeah, it's quite a contrast. And here we are starting to get some wage pressure as well. The labour market's held up nicely. But, gee, if you'd asked me a year ago, would I want to put some money on house prices going up 30% in a year, I would have thought, no way will that happen. But the combination of really, really low interest rates and the labour market being held up fairly strongly to a large extent because of the support the government's provided, has meant we've had this amazing situation where houses have become even more unaffordable than what they were when we ran into the pandemic. So very, very hard things for to balance up. And house prices per se aren't the central bank's focus here. But in terms of the broader policy mix, it's not that great to have house prices have gone up 30% over such a short space of time from that equality angle that's become so important as you've mentioned. So it'll be interesting to see if we stand out on our own for a bit. We've done that in the past before, but it tended to have not lasted too long. The other thing we're seeing here that's really rocketed up is our bond yield. So be it in the wholesale market for us to raise money or the government, our 10-year bond yield's gone from 0.5% this time a year ago to 2% today, which is still incredibly low, but a big step up. And that seems to be one of the things that's giving global markets a little bit of the jitters at the moment, is just these thoughts about higher long-term rates. How do you see that settling into the mix of things that investors have to worry about globally? And are you in the camp of rates settling at historically low levels, or do you think they could push higher than the ranges we've seen over the past 6 months because of some of these inflation concerns?
I think this is maybe the key question of the moment. So let's talk about it. So firstly, we think that the Fed, let's talk about the Fed, the world's most important central bank, I guess. We think they are going to be super slow to raise the Fed funds rate. So we think they do nothing in 22, maybe a couple of hikes in 23, and then not much thereafter. So they're going to do a very little bit and then a pause. So we are, BlackRock, we are quite dovish to the markets and even dovish to the Fed, the famous dot plot and all of that. So at the short end, we think interest rates are going to stay very low. But as you're saying, longer term interest rates are somewhat more governed by the market, right? They can move around a bit, as you've seen in New Zealand with that move from 50 basis points to 2. You're seeing versions of that kind of all over the Western world, at least, and we think that can continue. So what does that mean? It means that we are strategically, I suppose, underweight developed market government bonds, because as many of your listeners will know, if yields continue to go up, driven by inflation concerns or other aspects, other issues, if yields are up, that means the price of the bond is going down. So I would say this is a kind of key pillar for our overall portfolio framing, I suppose, is this idea that even though the Fed, the ECB, Bank of England, and others are going to stay kind of very dovish in terms of the bit of the interest rates they control, we think the market is going to continue to be incrementally concerned around medium-term inflation, and therefore not too fast, but over time, we can see yields continue to tickle higher, which, as I say, means the price of the bond is going to go lower. Hence, our strategic underweight for developed market government bonds is a view we hold at the moment.
Yeah, it links in with this question for those longer term bonds and their appropriate yields is, where does inflation finally settle? And the Reserve Bank, I guess, like most central banks, the wrap-up line is in the longer term we expect to inflation to average around whatever their target is, in our case 2%, so not too unusual there. And the Reserve Bank said that today. But gee, along the way, our inflation's going to hit, from consumer price inflation, hit 4% per annum, which is a pretty high number, and we're seeing that in other parts of the world, that suddenly from inflation being too low and bouncing around 0 to 1% from a consumer price index perspective, there's lots of places that have got inflation over 3% now, and we could probably do an entire podcast on whether inflation's transitory or more entrenched, and that's the $1 million question. With along with where do bond yields settle, I guess that only the next year or so will answer for us.
Yeah, I mean that you're right. I think that is the critical question, and so I have enough time in here in my little room at home. So I looked up the dictionary definition of transitory, and it means not permanent. So I guess transitory could be as long as you like, really, as long as it's not eternity. So and transitory, I think, is already persisting a bit longer than many, including some central bankers were expecting. And that, I think, is one of the reasons why I guess the market has got a little bit of the heebie-jeebies over the last week or two. For us, they're going to continue to treat it as transitory, we think, the Fed I'm talking about here, because it seems to us this is not your grandfather's Fed. They changed how they do their job formally in August of last year. And I won't go too into the weeds here, but I think this is a huge deal. They formally changed how they do their job, what the target of inflation is. They've moved from kind of a clear target to a fuzzy target, and that gives them a lot more discretion. And I think they're going to use that discretion to take on more of the burden of diversity and inclusive growth, sustainability and other issues, rather than just a narrow focus on inflation, kind of 2%. So my job, I think, is not to argue if that's right or wrong. It's just very different from the Fed of yesteryear, as it were. And for us, what that means is the Fed has the ability, even in the face of what looks, as you're saying, Chris, what looks like kind of high inflation, they have the ability to look through that. The new framework permits that, I suppose. And I think the Fed's going to use that to play their role supporting fiscal policy. I think the blending of fiscal and monetary policy is clearly happening. Again, that's something of a big change from the last maybe 30 or 40 years, going back to Volcker, Thatcher, all that stuff. And we term that a policy revolution. We think that's sort of a huge deal. So inflation, I think, whether it's transitory or not is one question, but I think the Fed's going to treat it as transitory, even in the face of relatively high prints. And that's going to give them the space, the framework gives them the space to stay dovish and to continue to look through it, even as oil prices drift higher, rent drifts higher, and so forth, because transitory means not permanent, and that can be a long time, of course.
Yeah, and at a really basic level, when a central bank has multiple targets, the Fed's really laying out their priority that the labour market and getting some real strength there is important, and they'll tolerate some inflation that goes along with it. And in the RBNZ's case, that's a new thing for us. The recent, it's not that recent now, but the change in government here always goes hand in hand with a fresh set of policy target agreements. And they did include the labour market over recent years. In the past, it's just been inflation, but of course the Fed's always been there, but it seems like there's a real clear skew that way. And my favourite magazine, The Economist, they had an article this week to say that the wage growth in the lower quartile was stronger in percentage terms than the higher quartile. So that's I guess it's working in that sense.
I think that's right. I think there's a few things going on. Maybe a bit less globalization, so harder to source cheap labor, and a few other aspects. But I think you're right. I think we're seeing the relative improvement of, let's say, lower skilled wages versus higher skilled wages. And I think many people politically perceive that to be, a good thing with a capital G. And I think, crucially, that would include the Fed. So I think, exactly as you said, Chris, I think the Fed isn't just prepared to tolerate some higher inflation. I actually think they want it, right? I think they think the mistake of the last couple of decades has been too little inflation and kind of a too hawkish structural bias and always worrying about inflation. It never happens. So I think they want to, in their framing, I think, kind of correct for that and therefore actually strive for higher inflation, because that should create higher nominal growth, which I guess can be a good thing, because maybe a consequence of that can be a tighter labour market, including for the poorest of society, and that's good. So again, that's not my view or my framing necessarily, but I think that's the kind of huge change in the political zeitgeist, I suppose, that's taken place maybe over the last 10 years or so, going back to the GFC. And I think that is, understanding that change of, not to get too pretentious here, Chris, but change of that philosophical approach is kind of a huge deal for understanding why we're seeing what used to be called unorthodox policy, right? QE and stuff, but it's been around for a decade. Yeah. So I guess it's now orthodox, and I think can persist.
Yeah, and when looking at the last couple of months, and clearly there's been some things that have given global investors the jitters, everything you're saying really reinforces this view that there's a lot of things underwriting growth at the moment, be it the government's deficits that they're prepared to run, and central banks preparing to give growth a decent chance and keep rates lower than what you'd normally think if we would apply the framework of 10 years ago, where they would be wanting to react to the sort of inflation pressure we've got now. So that's not a bad environment for many companies to deal with, as long as they're on the right side of some of the pricing pressures that are taking place. But are there any other things that you think are making markets a little bit nervous over the past month or so, when we've seen this I guess 4% retreat from the record highs we saw during the middle part of the third quarter?
I think there's an important nuance within the inflation debate. So there was a kind of a belief that it was very short term, kind of a positive demand shock as various countries moved from restrictions on to restrictions off. So you had like a positive demand shock. At the same time, maybe as some short-term supply bottlenecks caused by COVID inconveniences, I guess. So that was kind of the understanding. But I think over the last 2 or 3 weeks, there's been an increased concern that some of this supply side problem could be structural, crucially in the energy area. So, you can pick your favorite country, China, it's coal, Europe, it's gas, globally, I guess it's oil, but they're all going up something like a lot in terms of price. And I think what that's speaking to is a concern that there's a structural supply issue. And, to remind everyone, it takes 5 years to build an LNG natural gas terminal. So these, if indeed this is the problem, this is not a problem that can be solved with the flick of an interest rate from low to a bit higher. So I don't think necessarily that is the right kind of definitive answer, but I think the market has become incrementally concerned, not just about inflation, but about the type of inflation and it potentially being a little bit more structural and harder to get rid of, rather than the transitory short-term demand supply bottleneck inconvenience, but it will pass kind of thought, which was dominant as recently as 3 or 4 weeks ago, I think.
Yeah, and it's just one more thing to add onto the list of the permanent or transitory, and likewise some of the supply chain issues as things change have been around a lot longer than we forecast. One of the issues that popped up today when I was talking to a customer is they can't get pallets to ship things on. Now, those things, you used to see them lying all around any industrial area, just mountains of pallets. And now even pallets are tight for shipping goods. So it's just amazing how much changed. And a weird thing is here we are in October. Every now and then, over the past 30 years, people have always said to me, October's a terrible month to invest, or share markets are expensive. These are common things that seem to pop up every now and here we are with markets getting a little bit jittery in October again. But it's pleasing to see, as I said at the start of the podcast, that the New Zealand markets actually had quite a good patch over this period. So plenty of reasons for us to stick with our sort of longer term goals and diversified approach. The other thing we're seeing here is really strong commodity prices. So those we're agricultural commodities primarily here in New Zealand, but we are seeing really good prices for our export commodities. So there's some good news stories on the global price pressure front for New Zealand as well. So hey, we've taken up a lot of your time and got some great insights, but let's wrap up by just summarising what are the things you're going to be keeping an eye on over the rest of the year, and what do you think is important for investors to keep focused on over the closing quarter of 2021?
Yeah, Chris, it's been fun. Thanks for having me. I would say a couple of things in closing, I guess. Firstly, is we should stick to kind of our fundamental beliefs and not try to get whipped around too much by short-term market action. I'm extremely aware that is easier said than done. But for us, the key to our views is still very low global interest rates, indeed negative real rates. And that is just quite a positive backdrop for share markets globally. We read the papers. We're aware they've done quite well over the last couple of years since the depths of COVID, I guess, and even back 10 years if one wants to look further. But for us, if we have this combination of what we call an activity restart, hopefully coming to Singapore and New Zealand soon, moving to restrictions off, if we have that spreading from America, UK to kind of everywhere, that activity restart combined with still very, very supportive policy from many central banks, but of course, crucially, the Fed. That's just quite a positive backdrop. So we would definitely be advising, I suppose, not to get whipsawed by the last couple of weeks. There've been real concerns, as we've talked about through this podcast. But for us, that's a combination of a strong economic recovery plus still very supportive growth is still quite constructive. And hence we would be overweight equities within the portfolio, even after the good performance we talked about. So that would be my main takeaway is stick with the fundamentals. And as I say, we still think even with the performance we've seen, the fundamentals look quite encouraging for risk and share markets in particular.
Yeah, that's a reassuring message, and actually it's very similar to the way we what we heard from one of our local share fund managers, and in an earlier podcast, and shared the fact that not only is the economic environment beyond the immediate lockdowns, but the economic environment when it comes to interest rates and government support, not only is that really supportive and positive, add in a reopening and the fact that a number of companies' balance sheets are actually in really good positions. It's a far more encouraging situation than some of the headlines in the newspaper would certainly have investors thinking. So it's pleasant to finish on that note, and I hope we can talk again and compare notes in a few months' time, Ben. So thanks for your time today.
You bet. Great to be with you. Look forward to next time.
Thanks for listening to the ASB Investment Podcast. If you have any thoughts on today's episode, or if there's anything you'd like us to discuss on a future show, get in touch at podcasts@asb.co.nz.